There's one man who can make billionaires around the world nervous, and just by moving a number, sometimes by 0.5%. That's it. One decision in Washington, D.C., and stocks drop in New York. Currencies swing in Mumbai, borrowing costs jump in Nairobi, markets panic in Buenos Aires, all because that one number changed. In this video, we're going to break down how that tiny change moves the entire global economy. Stocks, bonds, real estate, currencies. We'll also look at real moments in history when interest rate changes shook markets. And once you see the mechanism, something strange happens. You'll never read a headline about interest rates the same way again. What even is an interest rate? It's the price of borrowing money. That's it. When you take a loan, you pay back more than you borrowed. That extra bit is the interest. Now, the Fed set something called the federal funds rate. Sounds important, and it is, but not for the reason most people think. Banks are legally required to hold a minimum amount of cash every night. Safety rule. Some days, a bank runs a little short. Too many loans went out that afternoon, so it borrows from another bank overnight. Just to square the books by morning, that's it. That's the federal funds rate, the price of that one boring, unglamorous overnight transaction. Now here's the part that actually matters. The Fed doesn't just suggest this rate, it sets a corridor. On one end, it pays banks a low interest rate for parking money with the Fed overnight. On the other end, it charges a high penalty rate if a bank borrows directly from the Fed. Now banks are profit-seeking machines. If you can lend to another bank and earn more than the Fed pays, you do that. If you need to borrow, you go to another bank first, because they're cheaper than borrowing from the Fed. So banks naturally trade with each other, right inside that corridor. The Fed never has to force it. Profit does the job. And this is the moment most people miss. When that overnight rate moves, it doesn't stay between banks. So when the overnight rate moves, mortgages move, car loans move, your credit card moves. Banks are not charities. They pass the cost on. And that's just the mechanism, how the rate travels. We haven't even talked about what happens when it actually moves, because that's where it gets truly wild. Here's the deal. The Fed has one sworn enemy: inflation. When prices rise too fast, your groceries, your rent, your petrol, the Fed basically needs to cool the economy down. And the way you cool an economy down is you make borrowing expensive. Expensive borrowing leads to people borrow less, leads to they spend less, leads to prices stop rising as fast. It's brutal, but it works. The data backs this up pretty clearly. There's roughly a 0.72 correlation between inflation and rate hikes. Meaning, inflation goes up, rates almost always follow. The most famous example is Paul Volcker, Fed chairman in the early 80s, who jacked rates to 20% to kill the inflation of the 70s. 20%. Imagine paying 20% interest on a business loan. Economies around the world screamed, and Volcker's response more or less was, "Not my problem." He wasn't joking. He literally said as much. He was there for America, not the world, which is wild, because as we're about to see, America's rates are the world's problem. Okay, let's talk bonds. Most people's eyes glaze over when you say bonds. But stay with me, because this is where things get genuinely dramatic. A bond is simple. You lend money to a government or company, they pay you interest over time, and return your money at the end. Here's the twist nobody tells you about. When interest rates rise, the value of existing bonds falls. Why? Because imagine you bought a bond paying 2% interest. Then the Fed raises rates and new bonds are suddenly paying 5%. Who's going to pay full price for your sad little 2% bond? Nobody. So the price drops. And here's where it gets interesting. If you're just holding the bond until it matures, you're fine. You get your money back, no problem. But if you're forced to sell early, you take a loss, a real, painful, account-draining loss. Which brings us to one of the most dramatic bank collapses in recent history. In March 2023, a $200 billion bank vanished in 2 days. It became the third largest bank failure in U.S. history. The cause? Interest rates. Here's how a few percentage points erased an entire bank. SVB wasn't some reckless gambling operation. It was a 40-year-old bank serving the tech world. Startups deposited billions there. Venture capital funds parked their money there. And like most banks, SVB invested those deposits, mostly in long-term U.S. government bonds. Supposedly the safest assets on earth. Then the Federal Reserve started raising interest rates fast, and suddenly those bonds were worth much less on the market. But here's the twist. Normally, a bank can just hold bonds until maturity and get its money back. SVB didn't have that luxury because something else was happening. What happens to startups when interest rates jump? Funding dries up. That's exactly what happened in 2022 to 2023. Venture capital slowed dramatically. Startups began burning their savings, which meant one thing. They started pulling money out of SVB. A lot of it. SVB needed cash fast, so the bank started selling its bonds. But selling bonds after rates rise means locking in huge losses. SVB announced it had taken a $1.8 billion hit. And that announcement triggered the real danger. Panic. Within hours, venture capital firms told startups, pull your money. What happened next was one of the fastest bank runs in history. $42 billion in withdrawal requests in a single day. SVB didn't have the cash. 2 days later, regulators shut it down. The third largest bank failure in U.S. history. Here's the disturbing part. SVB didn't collapse because it bought risky assets. It collapsed because it bought safe assets at the wrong time. And that's the hidden power of interest rates. Move them a few percentage points, and even the safest investments in the world can become lethal. When interest rates rise, the stock market doesn't collapse uniformly. It's more like an earthquake. Some buildings fall, some don't. Here's the simple logic. Companies borrow money to grow. Higher rates mean more expensive borrowing, leads to lower profits, leads to lower stock prices. But there's a second effect that's even more powerful. When bonds start paying 5% risk-free, why would any sane investor hold volatile stocks? They wouldn't, and many don't. Money flows from stocks to bonds. Stock prices fall. Now, not all stocks suffer equally. Tech companies get crushed. They rely on cheap debt to fund growth that may not pay off for years. When rates rise, those future profits are worth less in today's money, and borrowing to reach them gets expensive. It's a double hit. Financial stocks, on the other hand, can actually benefit, at first anyway. Banks charge more on loans and earn more on their reserves. But there's a catch. If borrowing gets expensive enough, people stop borrowing entirely, and that kills the bank's business too. So even the winners have a ceiling. Gold is fascinating. It doesn't pay you anything. No dividends, no coupons, no interest. It just sits there, glittering. And that's fine, when the alternative, U.S. Treasuries, is also paying almost nothing. But the moment Treasuries offer 5%, suddenly holding a shiny rock that earns you zero feels a little embarrassing. So investors sell gold and buy bonds. Gold prices fall. Simple supply-demand. Now here's the twist. Inflation complicates this. High inflation is usually why rates are rising. And inflation makes people want gold, because gold holds its value when currencies don't. So you get this tug of war. Inflation pushes gold up, rate hikes push it down. Whoever wins that fight determines which way gold goes. Now, here's the part that most people miss entirely. When the Fed raises rates, U.S. bonds suddenly offer better, safer returns. A fund manager in London, or Lagos, or Jakarta looks at their portfolio of emerging market stocks and asks one simple question. Why am I taking on all this risk when I can earn 5% guaranteed from the U.S. government? The answer is they don't have to, so they sell. Brazilian stocks, Indian stocks, Indonesian stocks. The money floods back to America. Local currencies tank. And here's where the spiral starts. As investors sell emerging market assets, they convert local currencies back into dollars. That creates massive demand for dollars. The dollar strengthens. A stronger dollar makes emerging market currencies worth even less, which makes their assets look even less attractive in dollar terms, which triggers even more selling. It is a self-reinforcing loop, and it is absolutely merciless. But the currency depreciation is not even the worst part. Here's something that most people genuinely don't know. Many large companies in India, Brazil, Turkey, and Indonesia borrow in US dollars. They do this because dollar debt has historically been cheaper. Smart move until the dollar strengthens. Because these companies earn money in rupees or reais or lira. But they owe debt in dollars. When the dollar rises 20%, their debt repayment costs rise 20% too, even if their business hasn't changed at all. Profit margins get crushed. Some companies face outright default. In 1982, after a major Fed tightening cycle, a basket of emerging market currencies depreciated 30% against the dollar. The Mexican peso fell 80%. 80%. In 1997, the Asian financial crisis followed a similar pattern. U.S. tightening contributed to capital flight and currency collapses across Southeast Asia. Argentina, Turkey, Sri Lanka, these aren't random disasters. They follow a pattern, and the pattern is almost always the same. A Fed tightening cycle, dollar appreciation, and countries that borrowed in dollars getting destroyed. Here's the thing that should bother all of us. The Fed doesn't set its rates with Kenya or the Philippines in mind. It sets rates for America. Inflation in America, jobs in America, and yet, the downstream effects land hardest on countries that had nothing to do with American inflation. A farmer in Turkey didn't cause inflation in the United States. But when the Fed raises rates, the Turkish lira can collapse. Imports become unaffordable. And that farmer's fertilizer, priced in dollars, suddenly costs twice as much. Paul Volcker said the quiet part out loud. We are going to do what is necessary for the United States, full stop. And in a world where the dollar is the global reserve currency, that means every other country is basically along for the ride, whether they like it or not. So here's the summary. The Fed raises interest rates to fight inflation. Domestically, borrowing gets expensive, growth slows, tech stocks fall, gold falls, bonds lose value if you're forced to sell early. Internationally, capital flees to America, local currencies collapse, dollar-denominated debt becomes crushing, and the most vulnerable economies spiral. The Fed lowers rates, and all of this runs in reverse. Capital flows back out. Emerging markets rally, growth accelerates, and sometimes inflates the next bubble. What SVB showed us, and what history keeps showing us, is that even the safest assets are dangerous if the timing's wrong. The question is never really if rates will move, it's when, and whether you'll be ready.